You people never learn, do you? I sit here in my chair, looking at the ticker tape in 2025, and I feel like I am watching a group of drunken sailors arguing over who gets to buy the deed to the Brooklyn Bridge. Except the sailors are supposedly sophisticated fund managers, and the bridge is a graphics processing unit. It is absolute insanity. We are witnessing a mass delusion that would make the Dutch tulip bulb traders blush with embarrassment. You look at the current market capitalization of these artificial intelligence darlings, these companies that promise to replace human thought with algorithms, and you have to ask yourself a very simple, rational question. Where is the cash? I do not mean the projected cash flow in the year 2035. I do not mean the adjusted EBITDA that ignores the massive cost of electricity and silicon. I mean the cold, hard cash that belongs to the owners of the business. It is not there. What you have instead is a story. And Wall Street loves a story because it is easier to sell a fantasy than it is to sell a boring, profitable business that makes ketchup or insurance. Let us look at the absurdity of the situation we find ourselves in right now. It is 2025, and the combined market value of the top 3 AI infrastructure companies now exceeds the GDP of entire continents. Does that make any sense to you? Do you really believe that a chatbot, no matter how clever it is at writing bad poetry or debugging code, is going to generate more economic value in the next 10 years than the entire industrial output of Europe? If you believe that, I have a bridge to sell you. Actually, I don't, because I don't deal in fraud. This is the Lollapalooza effect in full swing. You have a confluence of factors all pushing in the same direction to create a massive misjudgment of reality. You have the fear of missing out, which is a very powerful biological drive. You have the social proof of your neighbors getting rich on paper. And you have the narrative fallacy that tells you this time is different. It is never different. The technology changes, but the arithmetic does not. I look at the price-to-earnings ratios of these companies, and they are not just optimistic, they are mathematically impossible. To justify the prices you are paying today, these companies would have to grow at 50% a year for the next 2 decades. Do you know how hard it is for a large business to grow at that rate? It is virtually impossible. Biology prevents it. Physics prevents it. Economics prevents it. Eventually, you run out of customers. Eventually, competition enters the arena and crushes your margins. But right now, nobody cares about margins. They care about scaling. It is the same poison we drank in the late 90s, just in a different bottle. In 1999, we were told that profits didn't matter because the internet was going to change the world. Well, the internet did change the world. It changed everything. But if you bought Cisco or Sun Microsystems at the peak, you were decimated. You lost your shirt because you forgot that a great company can be a terrible investment if you pay a silly price for it. Today, in 2025, you are doing the exact same thing with AI. You are conflating the utility of the innovation with the value of the stock. Just because AI will be useful does not mean it will be profitable for you. The airlines transformed the world. They made travel possible for the masses. It was a miracle. And yet, for the first 100 years of aviation, the net return on capital for the entire industry was zero. It was a bottomless pit for investor capital. Why do you think AI will be different? Because a CEO in a black leather jacket told you so? Because a venture capitalist who needs to unload his bags on the public retail investor wrote a blog post about the singularity? This is veneno dorado ao quadrado. It is rat poison squared. You are buying hype, and you are paying a premium for the privilege of being the greater fool. The most ridiculous part of this current mania is the assumption that capital expenditures are the same as profits. You see these companies spending hundreds of billions of dollars on data centers and chips, and the market cheers. They say, look at the investment. Look at the growth. In my world, and in Warren's world, spending money is not a virtue. Spending money is a cost. We like businesses that throw off cash, not businesses that consume it like a furnace. If you have to keep reinvesting every single dime you make just to stay competitive, you do not own a business, you own a hamster wheel. And right now, the AI industry is the most expensive hamster wheel in human history. Everyone is running faster and faster, spending more and more, just to stay in the same place. You need to understand the concept of inversion. Invert, always invert. Instead of asking how much money you will make if AI takes over the world, ask yourself, how much will I lose if it doesn't happen as fast as the market expects? What if the adoption curve slows down? What if governments regulate it? What if the energy constraints are real? If any of those things happen, these stocks will not just correct, they will collapse. They are priced for perfection in an imperfect world. And that is the definition of insanity. You are standing on a cliff edge, looking at the beautiful view, ignoring the fact that the ground beneath your feet is crumbling. We at Berkshire sit on our hands. We hold our cash. We read our newspapers. And we watch you people run around like headless chickens, chasing the latest shiny object. It would be funny if it weren't so tragic. You are gambling with your life savings on a speculation that defies the laws of gravity. You are ignoring the lessons of history because you think you are smarter than the people who came before you. You are not. You are just the latest victim of the madness of crowds. And when this music stops, and it always stops, do not come crying to me. I told you so. The math simply does not work. You are paying $50 for $1 of earnings. That is not investing. That is charity. And I am not in the business of charity, I am in the business of compounding capital. The most expensive phrase in the English language is "this time is different." It is never different. The technology changes, the ticker symbols change, and the faces of the gurus on television change, but the script remains exactly the same. We have seen this movie before, and I can tell you exactly how it ends. It ends in tears. It ends with the permanent destruction of capital for the people who arrived late to the party. You look at this AI euphoria in 2025 and you think you are witnessing something novel. You are not. You are witnessing the standard cycle of human greed and stupidity that repeats itself every generation like clockwork. The reason you don't recognize it is that you do not read history. You are too busy looking at stock charts on your phone to pick up a book about what happened in 1929 or 1973 or 1999. If you did, you would be terrified. Let us go back to the 1920s. The great new technology was the radio. It was going to change everything. It was going to bring information and entertainment into every living room in America. And it did. It was a miraculous invention. The leading company was the Radio Corporation of America, RCA. It was the high-tech darling of the era. Speculators drove the stock price to the moon. They said valuation didn't matter because the growth potential was infinite. Does that sound familiar? RCA stock went from a few dollars to over $100 a share. Then the crash of 1929 hit. The stock lost more than 90% of its value. Now, here is the important part: radio actually did change the world. It was a massive success. But the people who bought RCA at the peak did not break even for decades. They were right about the technology, but they were wrong about the price. Being right about the innovation does not protect you from being slaughtered by the valuation. Fast forward to the late 1960s and early 1970s. We had the Nifty 50. These were the one-decision stocks. You bought them and you never sold them. They were the blue-chip giants of the era: Xerox, Polaroid, Avon, Kodak. Xerox was the AI of its day. It controlled the information flow of the office. It had a technological moat that seemed unbreachable. Institutional investors piled in, driving the PE ratios to 50, 60, 80 times earnings. They said, "These companies are so good, no price is too high." It was the same delusion you suffer from today. When the market broke in 1973 and 1974, those stocks were decimated. Polaroid, which was a technological marvel, eventually went to zero. Xerox spent decades as a zombie. The businesses were real, but the expectations embedded in the stock prices were pure fantasy. You cannot pay 80 times earnings for a mature company and expect a good result. The mathematics of compound interest work against you. Then, of course, there is the granddaddy of them all, the dot-com bubble of 1999. I remember it vividly. We sat at Berkshire Hathaway and watched people lose their minds. We were called dinosaurs. We were told we didn't get it. The narrative was exactly the same as the AI narrative today. They said the internet was the new electricity. They were right about the utility, but they were dead wrong about the economics. Look at a company like Cisco Systems. In March of 2000, Cisco was briefly the most valuable company on the planet. It was the picks and shovels play for the internet, just like the chip makers are the picks and shovels play for AI today. Cisco built the routers and switches that made the internet work. It was a great business with high margins. But the stock was trading at over 100 times earnings. If you bought Cisco at the peak in 2000, you are still licking your wounds 25 years later in real terms. The company continued to grow, the internet continued to expand, but the stock price had nowhere to go but down. The multiple compressed, and the investor was crushed. There's a famous quote from Scott McNealy, the CEO of Sun Microsystems, after the bubble burst. His company was one of the darlings of the era. He asked investors what they were thinking paying 10 times revenues for his stock. He walked them through the math. To justify 10 times revenues, he would have to pay out all his earnings for decades just to give you a meager return. And that was at 10 times revenues. Today, in 2025, I see AI software companies trading at 20 or 30 times revenues. It is absolute madness. It is not investing, it is speculation based on the greater fool theory. You are buying it only because you think you can sell it to a bigger idiot tomorrow morning. Eventually, you run out of idiots. We also see a parallel in the infrastructure build-out. In the late 90s, companies like Global Crossing and WorldCom spent billions laying fiber optic cables across the oceans. They thought the demand for bandwidth would double every 3 months forever. They were building the highway for the future. Well, they built the highway, but they went bankrupt doing it. The capacity glut was so massive that the price of bandwidth collapsed. Today, we are building massive data centers and energy grids for AI. We are spending trillions on GPUs. Everyone assumes the demand will be infinite. It won't be. At some point, the capacity will exceed the demand, pricing power will collapse, and the capital poured into this infrastructure will be incinerated. The benefits will go to the consumer, who gets cheap AI services, not to the investor who paid for the data centers. Capitalism is brutal that way. It loves to destroy capital in the pursuit of progress. The pattern is always the same. First, there is a genuine displacement or innovation. Then comes the boom, fueled by easy credit and excitement. Then comes the euphoria, where valuations disconnect from reality. Then comes the profit-taking by the insiders. And finally, the panic. We are currently somewhere between euphoria and the cliff edge. You think because you have a powerful computer in your pocket that the laws of economics have been suspended. They have not. Reversion to the mean is the most powerful force in finance. If a stock price goes up faster than the underlying business fundamentals, it will eventually come down. Gravity is not just a suggestion, it is a law. And right now, the AI sector is defying gravity. You are betting against history. You are betting against the accumulated wisdom of 300 years of financial markets. And I will take that bet against you any day of the week. The sad truth is that human nature does not change. We are driven by the same fear and greed that drove our ancestors on the savannah. We see our neighbor getting rich, and we cannot stand it. We suspend our critical thinking. We ignore the warning signs. We tell ourselves stories to justify our foolishness. In 1929, it was the plateau of permanent prosperity. In 1999, it was the new economy. In 2025, it is the singularity. It is all nonsense. It is all just a rationalization for paying too much for a business. If you ignore these patterns, you deserve the losses that are coming your way. I have lived through the Great Depression, the Nifty 50, the dot-com crash, and the housing bubble. I have seen smarter people than you go broke because they forgot to respect the cycles of history. Do not be one of them. People often think that high finance is complex, involving Greek letters and esoteric formulas that only a PhD in physics can understand. That is nonsense. The most important mathematics in investing can be done on the back of a napkin with a cheap ballpoint pen. It is simple arithmetic. And yet, the entire financial industry seems to have failed 8th grade math. Let us look at the numbers behind these AI darlings you are so obsessed with. I am going to walk you through the logic, and if you are honest with yourself, you will see that the current prices are not just high, they are impossible. They require a suspension of the laws of the universe. Let us start with the most basic metric, the price-to-earnings ratio. Right now, in 2025, the basket of leading AI stocks is trading at a PE multiple of somewhere between 60 and 80. Let us be generous and say it is 60 times earnings. What does that actually mean? It means that for every $60 you invest, you are buying $1 of current earnings. That is an earnings yield of approximately 1.6%. Now, compare that to the risk-free rate. You can go out today and buy a United States Treasury bond that pays you 4 or 5%. It is risk-free. It is guaranteed by the government. Why in the world would you swap a secure 5% return for a risky 1.6% return? The answer, you shout, is growth. You believe that the $1 of earnings will become $2, then $4, then $8, very quickly. But let us do the math on that growth. For a company trading at 60 times earnings to give you a decent return, let's say, to outperform the S&P 500 over the next 10 years, it cannot just grow, it must explode. If a company is worth $3 trillion today, and you expect a 15% annual return, in 10 years that company needs to be worth $12 trillion. That is larger than the GDP of almost every country on Earth. Do you really think a single company can extract that much value from the global economy? Trees do not grow to the sky. At a certain point, the law of large numbers kicks in. It becomes mathematically impossible to double your size when you are already the size of an elephant. You cannot compound at 30% a year forever. Gravity pulls you down. Now, let us look at the E and the P ratio. The earnings. The market is assuming that the profit margins for these AI companies will remain at astronomical levels, 70–80% gross margins. This assumes that AI is a monopoly business. But it is not. It is a commodity. Intelligence is becoming a commodity. Everyone is building a large language model. Google, Meta, Amazon, OpenAI, the Chinese tech giants, open source developers in their basements, everyone is flooding the market with supply. What happens in Economics 101 when supply floods the market? Prices crash. Margins collapse. You are valuing these companies as if they are unique diamonds, but they are selling sand in a desert. When the price of AI inference drops to near zero because of competition, those profit margins you are projecting will evaporate. And when the E drops, and the P stays high, the PE ratio goes to infinity, and your stock price goes to zero. Furthermore, we must discuss the most ignored number in this entire bubble, capital expenditure, or CapEx. These AI models are not free to run. They are voracious beasts. They consume electricity like small nations. They wear out expensive GPU chips that need to be replaced every few years. In the software days of the 1990s, you wrote the code once and sold it 1,000,000 times at zero marginal cost. That was a beautiful business. AI is different. Every time you ask the chatbot a question, it costs money in compute and energy. It is capital intensive. Wall Street ignores this. They look at adjusted EBITDA, which is a bullshit number. As I have said before, every time you hear EBITDA, you should substitute it with bullshit earnings. It excludes the very real costs of depreciation and stock-based compensation. If you look at the free cash flow, the actual cash the owner can take out of the business after paying for all those new data centers, it is often negative. These companies are burning cash to grow. They are running on a treadmill. You are paying a premium price for a business that has to reinvest every single penny it makes just to stay alive. That is not a wealth-generating machine, that is a wealth-destroying machine. Let's apply the Sun Microsystems test, price to sales. If you are paying 20 times sales for a company, you are implicitly saying that this company can pay you no dividends for years, while giving you all of its future revenue, just to justify your entry price. If a company has a 20% profit margin, which is generous, paying 20 times sales is equivalent to paying 100 times earnings. To get a 5% return on your money, assuming zero growth, you would need to wait 20 years just to get your principal back in revenue terms. But you need profits, not revenue. The math is atrocious. It requires the company to execute perfectly, with no regulation, no competition, and no energy crises, for 20 years straight. How many companies in history have done that? Very few. There's also the issue of the denominator problem. Investors look at the past earnings growth and project it forward in a straight line. This is linear thinking in a cyclical world. The earnings of the chip makers and the cloud providers are currently inflated because everyone is panic buying infrastructure. It is a one-time build-out. It is like the housing boom in 2006. Home builders were making record profits because everyone was building houses. But once the houses were built, demand dropped, and profits vanished. Once the data centers are built, the demand for new chips will normalize. The earnings will not just flatten, they will likely decline. And when you put a 60x multiple on peak cyclical earnings, you are setting yourself up for a disaster of biblical proportions. I look at these valuations and I see a complete detachment from reality. You are pricing in a utopia. You are assuming that AI will solve cancer, fusion energy, and world peace by next Tuesday, and that these specific companies will capture 100% of the value. Even if the first part happens, the second part will not. Technology benefits society, but it is often terrible for the investors in the specific technology stocks because competition competes away the profits. The auto industry changed the world, but GM and Ford have been terrible investments for long stretches of history. The math is shouting sell, but you are wearing noise-canceling headphones playing a podcast about how code is the new oil. It is pathetic. You are arguing with arithmetic. You are fighting the compound interest tables. In the long run, the market is a weighing machine. And right now, the weight of the cash flows does not support the weight of the valuations. The structure is buckling. You can support a bridge with papier-mâché for a little while if the weather is nice, but eventually, the rain comes. And the rain is coming. The returns you are expecting are mathematically impossible to achieve from these price levels. If you want to understand why you are about to lose your money, do not look at the balance sheet, look in the mirror. The problem is not the artificial intelligence in the silicon chips, the problem is the natural stupidity in your own brain. Investing is not a game where the guy with the 160 IQ beats the guy with the 130 IQ. Once you have ordinary intelligence, what you need is the temperament to control the urges that get other people into trouble in investing. And right now, in 2025, the collective temperament of the market is that of a teenager on a sugar rush. You are falling into every psychological trap that evolution has laid out for you. The most powerful force driving this bubble is not earnings growth, it is envy. I have always said that envy is the stupidest of the 7 deadly sins because it is the only one you don't even have any fun doing. But it drives the world. You see your neighbor, who you know is dumber than you are, making money in these AI stocks. You see him buying a new car or bragging at the country club about his portfolio of tech disruptors. And it eats you alive. You cannot stand it. So, you abandon your senses and you jump in, just so you don't feel left behind. This is the fear of missing out, or FOMO. It is a biological defect. You would rather lose money in a crowd than make money alone. This is powered by what we call social proof. It is the herd instinct. When you see everyone running in one direction, your brain screams at you to follow them because, on the savannah, if everyone was running, it usually meant there was a lion. Today, there is no lion. There is just a cliff. But you are following the herd right over the edge. You look at the price action and you think, the market must know something I don't. That is false. The market doesn't know anything. The market is just a collection of hysterical people reacting to each other. When you buy a stock because it is going up, you are outsourcing your thinking to the mob. And the mob is always wrong at the extremes. Do not think for a second that the so-called smart money is immune to this. The institutional investors, the hedge funds, the pension funds, the mutual fund managers, are often the worst offenders. They suffer from the institutional imperative. If an asset class is hot, they must own it. If they don't, and the market keeps going up, they lose their clients and their jobs. It is career risk. A fund manager would rather fail conventionally than succeed unconventionally. So they pile into the same crowded trade, buying the same overvalued AI stocks, not because they believe the valuation is correct, but because they are terrified of underperforming the S&P 500 for another quarter. They are cheap, inexpensive suits. They are not allocating capital, they are hugging the index to protect their fees. We also see a massive case of commitment and consistency bias. You have already bought the stock. You have told your spouse you are a genius. You have posted about it on social media. Now, when the bad news starts to trickle in, when the CEO sells his shares, or when the growth slows down slightly, you cannot accept it. Your brain filters out the negative information to protect your ego. You become an apologist for the company. You say, oh, the insider selling is just for tax planning, or the slowdown is just seasonal. You are lying to yourself to maintain consistency with your previous bad decision. You are digging the hole deeper because you cannot admit you were wrong. Then there is the Pavlovian association. For the last 2 years, every time a company mentions AI or generative in a press release, the stock goes up. You have been conditioned like Pavlov's dog. Bell rings, dog salivates. CEO says AI, stock jumps, you buy. You are not analyzing the business, you are reacting to a stimulus. Scammers know this. That is why every failing company in 2025 is suddenly pivoting to AI. They are ringing the bell because they know you will salivate. It is cynical, it is manipulative, and it works every single time because you are too lazy to do the work. You are also treating the stock market like a casino. The apps on your phone are designed to trigger dopamine hits. The flashing lights, the green numbers, the confetti when you make a trade, it is gamification. It bypasses your frontal cortex and goes straight to the lizard brain. You are getting a chemical high from the act of speculation. This is not investing. Investing is boring. Investing is watching paint dry. If you are having excitement, if your heart is racing when you look at your portfolio, you are gambling. And the house always wins eventually. Another dangerous mental model at play here is denial. You refuse to look at the opportunity cost. You refuse to look at the downside. You have convinced yourself that this time, the trees really will grow to the sky. You have created an echo chamber. You only read the bullish analysts. You only watch the YouTube channels that confirm your bias. You block out the skeptics. You dismiss me as an old, out-of-touch man. That is fine. Being out of touch with madness is a compliment. But this denial serves a purpose, it shields you from the pain of reality. But reality is patient. It waits. And when it finally breaks through your denial, the psychological devastation will be as bad as the financial ruin. Finally, you are suffering from the illusion of control. You think because you can trade instantly, because you have charts and data feeds, that you are in control of the outcome. You are not. You are a cork bobbing in a hurricane. The forces moving these markets are macroeconomic, geopolitical, and algorithmic. You have zero control. The only thing you can control is your own behavior, your own rationality. And you are failing at that. You are letting your emotions drive the bus while your intellect is tied up in the trunk. This psychological cocktail, envy, social proof, denial, dopamine seeking, is a lethal mixture. It is the Lollapalooza effect of human misjudgment. It creates a feedback loop where higher prices beget higher prices, until the whole thing becomes so detached from reality that a butterfly flapping its wings causes a crash. You need to step back. You need to detach. You need to look at these behaviors in yourself and root them out with extreme prejudice. If you cannot control your emotions, you cannot control your money. It is that simple. The market is a device for transferring money from the impatient to the patient. Right now, you are the impatient one. You are the patsy at the poker table. And if you don't know who the patsy is within 30 minutes, it's you. The great algebraist Carl Jacobi had a simple instruction for solving difficult problems: invert, always invert. If you want to help India, the question is not how can I help India? The question is what is doing the worst damage to India, and how do I stop it? In investing, the same logic applies. Instead of asking how do I get rich quick with AI, you should ask what will make me poor, and what is the likelihood that this investment goes to zero or suffers a permanent impairment of capital. When you invert the situation with these high-flying AI stocks, the picture changes from a beautiful dream to a nightmare. Let's look at the downside. Everyone is priced for the upside. They are priced for a world where regulations don't exist, where energy is infinite, and where competition sleeps. Invert that. What happens if the government steps in? We are already seeing antitrust clouds gathering in 2025. Governments do not like it when a handful of tech bros control the levers of information and productivity. What happens if they break these companies up? Or tax their excessive profits? What if the energy grid simply cannot handle the load? You are betting on a perfect execution in a chaotic world. If you buy a stock at 60 times earnings, and the growth rate slows from 30% to 15%, the multiple will compress to 20 times earnings. That is a mathematical certainty. In that scenario, the business is still growing, but you have lost 2/3 of your money. That is the cost of paying a perfection price for an imperfect asset. Now, let us talk about the most fundamental concept in economics that you are currently ignoring: opportunity cost. Everything you do in life is a trade-off. If you marry one person, you cannot marry another. If you buy stock A, you cannot buy stock B. The definition of a smart investment is not just will it go up? It is this the best use of my capital compared to everything else available? And right now, the alternatives to AI speculation are historically attractive, yet you ignore them because they are boring. Look at the risk-free rate. In 2025, you can sit on your rear end and collect a guaranteed 4.5% to 5% yield from short-term U.S. Treasuries. That is your hurdle rate. That is the bar you must jump over. If you are going to take on the massive risk of an equity investment, the risk of volatility, the risk of obsolescence, the risk of management stupidity, you should demand a significant premium over the risk-free rate. You should want at least 10% or 12% to justify the headache. But as we established, at current valuations, the implied return of these AI stocks is often lower than the Treasury yield. You are taking on equity risk for bond-like returns. That is not just bad investing, that is stupidity. You are picking up pennies in front of a steamroller. Consider the boring businesses. While everyone is fighting over the AI scraps, there are wonderful businesses trading at 10 or 12 times earnings. Companies that make food, that transport energy, that insure risks. These are businesses with moats, protective barriers around them. They generate cash today. They pay dividends today. If I can buy a business that yields 8% in cash flow right now and grows at a modest 3% a year, I am going to get a decent, safe return. Why would I trade that for a casino ticket that might pay off in 2035? You are ignoring the bird in the hand to chase the two imaginary birds in the bush. Think about the cost of a loss. If you lose 50% of your capital in a tech crash, you need a 100% gain just to get back to even. That is the cruel arithmetic of loss. If you stay in cash or safe equivalents, you preserve your ammunition. The greatest advantage an investor can have is a pile of cash when everyone else is panic selling. When the AI bubble bursts, and prices will collapse. Great businesses will be thrown out with the bathwater. At that moment, the person with cash is king. The person who is fully invested in overvalued tech stocks is the victim. By buying now, you are depriving yourself of the opportunity to buy later at a bargain price. You are eating your seed corn. I also want you to invert your own competence. What do you actually know about the technical architecture of neural networks? Do you know which chip architecture will be dominant in 5 years? Do you know which software layer will capture the margin? Be honest. You don't know. I don't know. Warren doesn't know. That is why we put it in the too hard pile. There's no shame in saying I don't understand this. The shame is in pretending you understand it and betting your retirement on it. We make money at Berkshire by knowing the edge of our circle of competence and staying inside it. You are wandering out into the middle of a minefield because you saw someone else run across it without exploding yet. Consider the energy sector. Everyone says AI is the future. Fine. But AI runs on electricity. Massive amounts of it. The real bottleneck in 2025 is not silicon, it is electrons. Yet, while the tech stocks are priced for perfection, the energy infrastructure companies, the utilities, the natural gas producers, the ones who actually make the AI boom possible physically, are often trading at reasonable valuations. This is second-level thinking. If you truly believe in the AI boom, why buy the overvalued software company? Why not buy the undervalued energy company that sells them the electricity? It is the classic picks and shovels strategy, but even deeper. But you don't do that because utility stocks don't double in a month. You are addicted to the action, not the value. The opportunity cost of your attention is also real. While you are glued to the screen watching the ticker of some AI chatbot company, you are missing out on finding small, neglected, mispriced opportunities in other parts of the market. You are missing out on reading, on learning, on thinking. You are caught in the hype cycle. So, invert the proposition. What if the skeptics are right? What if AI is just a better version of Clippy from Microsoft Word? What if the productivity gains are marginal, not revolutionary? Then these stocks are worth 80% less than they are today. Can you afford that? Can your family afford that? If the answer is no, then you have no business being in this trade. You are betting the farm on a weather forecast. Smart people do not do that. Smart people look for the margin of safety. They want to buy a dollar for 50 cents. Right now, you are buying a dollar for $5 and hoping it turns into a magical $10 bill. In investing, you don't get paid for the difficulty of the problem. You get paid for being right. It is much easier to be right about a company that sells ketchup or insurance than it is to be right about a company inventing a digital god. And the ketchup company is probably cheaper. Why play the game on hard mode when the payouts are better on easy mode? It is ego. Pure and simple. Put your ego aside. Look at the alternatives. Cash is not trash when the market is irrational. Cash is an option on future sanity. Hold your cash. Wait for the fat pitch. It hasn't come yet. We have reached the end of this lecture, and if you have been listening, you should be terrified. If you are not terrified, you are either incredibly wealthy or incredibly foolish. I suspect for most of you, it is the latter. I have walked you through the history of financial delusions, the impossibility of the current mathematics, and the psychological defects that are causing you to set your money on fire. Now, I will tell you exactly what to do. I will not mince words. I am 90-something years old, or in this simulation, over 100, and I do not have time for politeness. I care about what works. Here is your verdict: get out of the casino. If you are holding these speculative AI stocks that are trading at 80 times earnings, sell them. Sell them down to the sleeping point. If you cannot sleep at night because of your portfolio, you are holding too much risk. Take your profits, pay your taxes, which are a privilege to pay, by the way, as it means you made money, and put the proceeds into something safe. Do not worry about missing the top. No one rings a bell at the top. It is better to leave the party 2 hours early than 1 minute late. The person who stays until the end usually ends up cleaning up the mess. What should you do with that cash? You sit on it. I know. It sounds boring. You want action. You want to make your money work for you. That is a cliché sold to you by brokers who want your fees. Sometimes, the best thing your money can do is sit in a short-term treasury bill, earning a safe return, and waiting for the world to come to its senses. Cash is not a drag on performance. Cash is an option check with no expiration date. It is the ammunition you need when the hunting is good. Right now, the hunting is terrible. The woods are full of other hunters shooting at each other. Stay home. Read a book. You need to cultivate the art of sit-on-your-ass investing. It is a technical term. You do the work, you buy a great business at a fair price, and then you sit on your ass. But right now, there are very few great businesses at fair prices. So, the sit-on-your-ass part applies to holding cash. You must have the patience of a saint and the discipline of a monk. You must be willing to look like an idiot for a year or two while your friends get rich on paper. Let them brag. Let them laugh at you. In the long run, the scorecard is all that matters. And the scorecard of the disciplined value investor always beats the scorecard of the frenzied speculator. Stop trying to be smart. Trying to be smart is how you get into trouble. You try to predict complex systems, you try to time the market, you try to understand technologies that are changing every week. It is too hard. Instead of trying to be smart, just try to be consistently not stupid. If you can avoid the standard stupidities, overtrading, overpaying, using leverage, following the herd, you will end up in the top 5% of investors just by default. It is remarkable how much advantage you get in life simply by not being an idiot when everyone else is losing their minds. Avoid leverage like the plague. If you are using margin to buy AI stocks in 2025, you are holding a grenade with the pin pulled out. Leverage magnifies your stupidity. If you are smart, you don't need it. If you are dumb, it will ruin you. There are only 3 ways a smart person can go broke: liquor, ladies, and leverage. Well, actually, in 2025, maybe we should add large language models to that list. Do not borrow money to gamble. It is that simple. If you invest with your own money and you are wrong, you have a bad year. If you invest with borrowed money and you are wrong, you are destitute. Develop a circle of competence. Draw a circle around the things you truly understand. If it is local real estate, fine. If it is bank stocks, fine. If it is ketchup, fine. But do not step outside that circle just because the crowd is running there. The size of the circle does not matter, knowing its boundaries is what counts. I do not understand the intricacies of the latest neural network architecture, so I do not invest in it. I miss out on some winners, sure. But I also miss out on the catastrophes. I sleep very well at night. Can you say the same? Beware of the consultants and the experts. They are not paid to make you money, they are paid to sell you things. They will tell you that you need to be diversified into the latest asset class. They will tell you that modern portfolio theory requires exposure to high-growth tech. It is balderdash. Diversification is often just a protection against ignorance. If you know what you are doing, you don't need to own 50 stocks. You need to own 3 wonderful businesses. If you don't know what you are doing, buy the index fund and go back to work. But do not buy a basket of overvalued hype because a man in a suit told you it was prudent. Finally, remember that character is destiny. Your financial outcome will be determined more by your character than your IQ. Do you have the emotional stability to stand alone? Do you have the integrity to admit when you are wrong? Do you have the humility to learn from your mistakes? These are moral qualities, not intellectual ones. The market is a brutal teacher. It will find your character flaws and it will exploit them. If you are greedy, it will bait you. If you are fearful, it will scare you. If you are arrogant, it will humble you. Work on your character. Be rational. Be honest. Be patient. This AI bubble is just another chapter in the long history of human folly. It will burst. The prices will crash. The experts will look foolish. And the people who kept their heads, who held their cash, and who waited for the fat pitch, will step in and buy the wreckage for pennies on the dollar. That is how dynasties are built. Not by chasing the shiny object, but by waiting for the shiny object to tarnish and fall into the mud, and then picking it up when no one else wants it. Go find a simple life. Spend less than you earn. Invest the difference in things you understand. And for God's sake, stop looking at the ticker tape. It is hazardous to your mental health and your wallet. I have nothing more to add.